For Morningstar, I'm Jeremy Glazer. I'm joined today by Joe Davis. He's Vanguard's global chief economist. We're going to look at some of the market turmoil and his take on it. Joe, thanks so much for joining us.
Thanks, Jeremy. Glad to be here.
So let's start in China. That seems to be the proximate cause of what's really driving this market turmoil right now. Do you think it's reasonable that a slowdown in China, or perceived slowdown in China, is really going to have a major impact on the U.S. and European economies?
Well, I think it has already had an impact. I mean, I think it's important for everyone to keep in mind that China's been slowing both deliberately and perhaps more recently, a little bit unexpectedly, for 7 years. I mean, they've had an intentional slowdown that's been in the works. But the indicators we look at, have been pointing to growth at times of closer to 5-6%, well below their 7% sort of plan. So, I think it's reasonable to assign some of the headline and volatility to the weaker than expected numbers from China. But some of this should not be really news to the market, quite frankly, because this has been a long running slowdown in China for some time.
So if only part of this can be attributed to China, what do you think are some of the other factors that are weighing right now?
Well, I think there was a period, quite frankly, in our mind, of somewhat of market complacency. Clearly we've had this duality between in the world between deflationary risk still pervasive in our mind, and will continue to be so, and yet economic conditions weak overseas, but in the U.S. fairly resilient. So this sort of tension around potential for Fed liftoff, then you weigh that with just disappointing news outside the U.S. on the economic front. I think it's natural we're seeing this sort of lot of volatility on the backdrop of valuations, which in our mind were stretched, particularly in the equity market. So, we had a very guarded outlook for the financial markets going into the year. I would not have forecast what happened last week and today, but it's also not surprising to see.
You mentioned the Fed there and the potential of a Fed rate hike. Do you think this kind of market volatility, worries about global growth, will that stop the Fed in September?
Well, I think that those odds have increased materially. I said, if you would have asked me a week or two ago, I think that the U.S. domestic conditions will clearly warrant a Fed gradually lifting off and, still very, very tepid pace. I mean, we've been hard-pressed to see the Fed raising rates above 1% over the next 2 or 3 years, which is well below where I think that the Fed is. But I think, the past week, the Fed will care about financial conditions, and you could make a strong argument that the U.S. dollar has effectively tightened policy for the Fed already. And so I think at the margin, risks may still be asymmetric, modestly to weaker than expected inflation. And inflation's been below the Fed's target for over 3 years, as you well know, Jeremy. So I think this will lead them to pause, particularly since the U.S. is the only major developed market that's growing modestly above its lower trend growth pace.
Do you think a Fed waiting, or if the Fed does wait, does that have any impact on the real economy? Is it really going to make a big difference for growth?
I don't think so. I mean, I think it would be more of avoiding, at least in the market's perception, of a policy mistake, which, and I think 25, even 50 basis points for that matter, is not going to materially impact, most business, consumer, and lending decisions. But by stalling, should they pause? I think that would avoid the risk of the market at least perceiving the Fed being too aggressive, and so in that sense, financial conditions would be somewhat more supportive. But for the past 2 or 3 years, financial conditions they've obviously deteriorated, but they're clearly coming from a very strong level, and has been a really strong source of headwind for the U.S. economy for the past 2 years.
If you were concerned about stock valuations before the correction, post-correction, do things look much more attractive, or is it really more of coming back to kind of a fairly valued level?
Yeah, I mean, when you look at it on the moving average basis, which we tend to do, because we're going to have some of these, periodic flare-ups, we're still guarded. And again, we're not bearish by any means. And we tend to look out 5 or 10 year period or more, because the near term, any predictability near term is very low at best. But we still are somewhat guarded. That said, I think some of the froth that we were seeing in parts of the equity market, it's harder to make that case today unless one is very bearish on global growth, and we're not. And if there is a history of markets perhaps overshooting, I think areas such as in commodities and elsewhere, I mean, some of the fall in commodity prices parallel those we've seen in 2008, 2009. So not all that supply related. So I think it's important not to get too bearish in the market environment, but we also would be cautious that our guarded outlook that we had beginning the year, this sort of environment that we're seeing may not be the end of it.
How about in the fixed income space? Any changes to your outlook there?
No, I mean, we went to the year, ironically, one of the few so-called risk premiums that at least historically was at least close to averages was the shape of the yield curve. Yields are low, but the yield curve was fairly steep on the Treasury side. That's obviously compressed a lot. I think, those that have, more, corporate-like exposure, clearly EM, they've been battered a little bit. Valuations in parts of the fixed income market, at least relative to history, weren't as stretched as parts of the U.S. equity market. It's just the base rate or the short rate is so low, which really drives everything at an absolute level. So again, I think you're going to have this high beta relationship as we have had in the past between equity market volatility and areas in the fixed income market outside of U.S. Treasuries, and I don't see that changing in the near term.
Well, Joe, I certainly appreciate you taking the time to talk to us today.
Thank you, Jeremy. My pleasure.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.